Ladies and gentlemen, good day and welcome to the Q1 FY23 earnings conference call of LIC Housing Finance, hosted by Axis Capital Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Praveen Agarwal from Axis Capital. Thank you, and over to you, Mr. Agarwal.
Thank you, Margaret. Good morning, everyone. And from the management team, we have Mr. Y. Vishwanath Gaud, MD and CEO, and Mr. Sudipto Sil, CFO, to take us through the key highlights of the call, post which we'll open the floor for Q&A. Over to you, sir, for the opening remarks, please.
Thank you, Praveen. Friends, very good morning and a hearty welcome to every one of you to the post-earnings conference call of LIC Housing Finance Limited. As you are aware, we declared our results for Q1 FY23 yesterday. Prior to detailing the operational aspects, I would like to highlight that a strong momentum in the economy was witnessed throughout the quarter as compared to the previous quarters over the last 2 years, which is reflected in the robust growth in the disbursements. The quarter under review also witnessed a 90 BPS policy repo rate hike. In aggregate, the 2 consecutive MPC meetings held in May and June, and also another 50 basis points hike today. As a result, the company also raised its benchmark lending rate by 60 BPS in June 22 in response to the earlier 90 BPS policy repo rate hike. As reflected in the strong disbursements numbers in Q1, the current year promises to be better than the last 2 previous years. The financial highlights of the quarter are as follows. Key highlights of the quarter results. Number 1, the total revenue from operations were 5,285 crore as against 4,857 crore for the corresponding quarter of the previous year. It is up by 9%. Outstanding loan portfolio stood at 2,55,712 crore against 2,32,548 crore as on 30th June 2021, reflecting a growth of 10%. Out of which, the individual home loan portfolio stood at 209,599 crore as against 182,055 crore. It is up by 15%, and now it comprises 82% of our total portfolio. It is also up from 78% 1 year ago. The total disbursement for the quarter were 15,201 crore as against 8,652 crore. It is also up by 76%. Out of the disbursements in the individual home loans were 13,131 crore as against 7,650 crore with a growth of 72%. Disbursements in project loans were 309 crore as against 237 crore for the same period previous year. Net interest income rose by 26% to 1,660 crore as against 1,275 crore for the same period in the previous year. Net interest margins for the Q1 FY23 stood at 2.54% as against 2.2% for the Q1 of FY22. Profit before tax for the quarter was 1,140.36 crore as against 192.93 crore in Q1 of FY22 with a growth of 491%. Profit after tax for the quarter stood at 925.48 crore as against 153.44 crore for the same period previous year with a growth of 503%. Loan disbursements during the quarter was very strong with 76% growth in total disbursements over Q1 of last year. Geographically, the growth remained evenly distributed across the various regions with southeastern, western and southern in the leading. Our mobile platform, HOMI app, it continues to add value and it accounted for over 6,500 crore in the sanction during this quarter. In terms of asset quality, stage 3 exposure at default as on 30th June 2022 stood at 4.96% as against 5.93% as on June 30th, 2021. The total provisions as on 30th June 2022 stood at 6,141.03 crore as against 4,727.02 crore as on 30th June 2021 and 5,839.11 crore as on 31st March 2022. This includes 619.10 crore for COVID-19 related provisions. As of June end 2022, we have seen 4,500 crore approximately exiting out of OTR. On the funding side, our cost of funds were at 6.7% as compared to 6.88 as on 30th June 2021. Despite the rising interest scenario in the market, we have been able to bring down our cost of funds on year-on-year basis. Incremental cost of funding stood at 5.44 for Q1 of FY23. With this brief introduction, I would like to invite you for your queries. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sanket Chedda from B&K Securities. Please go ahead.
Yeah, hi sir. My question was on asset quality. So last quarter we had a restructuring of 7,800 and which was sitting in stage 1. This quarter seems to be there is some flow to stage 2 and stage 3. So what was that flow and how much restructuring is outstanding?
Yeah, good morning. See, out of the 7,800 was the total OTR that has happened, and every quarter, as you know, some of it is exiting. As of today, including last few quarters put together, about 4,500 exits have been there. In terms of movement in the various stage buckets, you would have seen an increase in the stage 3 by roughly around 1,000 crores. That is partly due to the movement in the OTR and partly due to the non-OTR accounts.
So how much is the OTR outstanding now in stage 1?
See, in stage 1, total OTR outstanding right now is about 2,060 crores, about 2,100 crores you can say, which is both having interest and principal moratorium, and about 1,000 crores, which you can say it is partly in OTR because they are servicing the interest, but they are having a principal moratorium.
Okay, so 3,000 crore is what sits in stage 1 against 7,800 crores last quarter. Is that right?
No, not in entirely stage 1. As you would note that this quarter what we have also done is that we have actually marked those specific accounts in the buckets that they were belonging to pre-OTR. So some of these accounts which were in stage 1 earlier, we have actually put them in stage 2 as was their specific DPD prior to the invocation of the OTR.
So sir, can you give a simple math like 7,800 was last quarter in stage 1. From that, how much?
It was not in stage 1. It was in stage 1 and stage 2 put together. It was not in stage 1. The OTR was not in only stage 1. It was in stage 1 and stage 2 put together.
Okay. So
right now, the OTR outstanding numbers which I have told you is about 2,000 crores which are both in interest and principal moratorium, and about 1,000 crores which are servicing the interest but they are in principal moratorium.
So last quarter you gave 78 billion. Against that, what is the number this quarter?
Yeah, that is about a little less than 3,000.
Okay. And second question is, sir, this quarter now we have increased our PCR on stage 2, but that has entirely come because we shifted 392 crores from stage 1 as a provision, as a result of which now the provisioning on stage 1 is just 7 bits. I think regulatory requirement on standard asset is also 25 bits, right? It's much lower than that now.
No, it is not that way. Actually, if you look at it, the regulatory provisioning which is there, that is as per the RBI IRAC norms, and it is actually fully and adequately provided. This what you are talking about, stage 1, stage 2, stage 3, this is basically on an ECL provisioning account. And this also, if you see on a year-on-year basis, there has been an increase. Of course, there has been a movement from stage 1 to stage 2, as we have rightly identified, and that has happened because some of these OTR accounts which were earlier being marked as stage 1 are now in stage 2, not because of any change in the DPD, but because we have actually migrated them to a position which was there prior to the invocation of the OTR.
So 7 bits is very adequate, you mean? And
Yeah,
anyway, next quarter we need to move to IRAC. So.
No, next quarter we don't have to move to IRAC. I'm not able to understand your query.
No, so IRAC reporting.
IRAC reporting is parallelly happening. No, there is no change in that. That we have been following since December. If you are talking about the November 12 circular.
No, so in stage 3, we have 4.96%, right? But there are certain assets as per that RBI circular, which we are still having in stage 2, right? This 4.96 number is not the IRAC number, is that right?
No, the IRAC number is separate. IRAC number is different. Huh?
So that's what I'm saying.
So we are not this is stage 3.
As of now.
No, that is fully adequately provided. If you look at the provisioning, overall provisioning now.
Yes, sir. But I'm saying that there will be some increase in next quarter, right? As we.
If you look at, I'll just share with you a few data points that will help you understand. The total coverage ratio sequentially on 2.5 lakh crores of assets has moved up from 2.32 to 2.40.
Correct. That's correct.
That's correct because our deterioration.
Similarly, the total coverage ratio on the project loans, that has also increased from 11.6% as of March to 13.45% as of June.
Correct.
But our stress has also increased, na, sir? Stage 2, stage 3 has increased. But anyways, yeah. Also, this I wanted to confirm that both these numbers would be different. Like 4.96 is not the IRAC number. That's a different number you are saying. So,
yeah, RBI IRAC is independent and different. And there also, if you look at the IRAC, as per the IRAC provisioning norm, whatever be the IRAC NPA, GNPA number, which is at 5.35, which is also separately disclosed, there also it is fully provided as per the extent IRAC norms.
Okay.
Because you have to understand that this is a regulatory requirement, so there cannot be any leniency or any relaxation on a regulatory requirement.
Sure, sir. And keeping 7 bits on stage 1 is also fine as per you, right?
Yeah, if you look at on a year-on-year basis, it has improved.
Sure, sir. Those were thanks.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all participants, we would request you to please limit your questions to 2 at a time. Should you have a follow-up question, please rejoin the queue. Thank you. The next question is from the line of Mahrukh Adajania from Edelweiss. Please go ahead.
Yeah, hello. I have 2 questions. Just following up on Sanket's question. So, you said that the total exits from OTR over the last few quarters have been 4,500 crores, right? And those have been over the last few quarters. What has been the exits in the first quarter? As in 7,800 has gone down to 3,000 or?
No, actually the 7,800 was the total amount of OTRs granted.
It is around 3% of our entire loan.
It was 3% of our. So that was the figure that, in fact, in the public disclosures also, we would have seen that is the total amount of OTRs which have been given by the company ever since the OTR program has been announced by the government, by the Reserve Bank. So that is the total 3%, which was translating around 78 billion or 77 billion. That was the total figure. As of now, the outstanding figure I've just shared in the previous query.
Yes, 3,000 crores. But what I'm saying is that the 4Q may not have been 7,800, right? It could have been lower.
It would have been lesser, yes. It would have been lesser.
Okay. Any quantification on how much has slipped from restructured in Q1?
Sorry?
What is the slippage from restructured loans into stage 3 in Q1?
See, roughly around, you can say about 400 odd crores, 400 to 450 crores.
400 to 450 crores actually.
Correct.
Okay. Got it. And just one question on spread. So you've given the portfolio yield and the portfolio cost of borrowing.
Correct.
If you deduct if you deduct cost from yield, you get a spread of 1.3%. Whereas if you actually see your net interest income, and then, try to calculate the spread on the balance sheet, it comes to a figure higher than 1.3%.
Correct. Right.
So how do you tally the thing?
I'll explain it this way. The spread that is reported in our communication, that is basically taking into consideration the yield on the entire advances and the weighted average coupon on the, you can use the word coupon, the weighted average coupon on the total liability side. So that is on a quarter end or end of quarter reporting date. Now, if you look at the way the interest rates have moved, April was fairly stable. It was only from May where the cost of fund had actually started increasing. So that, I think, will answer your query.
Okay. Makes sense. Thank you so much.
Thank you.
Thank you. The next question is from the line of Shubhanshu Mishra from UBS. Please go ahead.
Hi, sir. Good morning. Thank you for the opportunity. A couple of questions on the demand and second on the liability mix. So, what sort of demand are we seeing in the individual housing, and can you please split it into the top 7 cities versus the rest of the country? That's the first on individual housing loans. And what's our own estimate going forward for the next 15 to 18 months? Second is on the construction finance. Have we been seeing incremental competition there from banks because very high quality developers are remaining right now who want more debt? So is that the reason that our disbursements are low, or is it because that we consciously want to keep it low as a proportion of our AUM? So if we can speak on that as well, that will be very helpful. And the second question is on the cost of funds. What proportion of our bank borrowings are on EBLR versus MCLR, and what sort of pass-through do we think banks are going to give us going forward?
Yeah, okay. As for the demand, what you are asking is, there is a robust demand even Q1 we could see, and even going forward also there will be very good demand for individual housing loans across all the regions. One good thing actually after COVID vaccination, then full momentum now is almost actually now we have regained. Across all regions there is a very good demand for housing, especially which is a basic need. The demand is mainly driven on 2-3 factors. In that, main one is now the property rates are almost stable for long. So probably people would like to now lock in at these rates. That's one thing driving. And here and there some small spikes in the interest rates may not be a major deterrent for the people to go in for housing loans. That's one thing as far as the individual housing loans are concerned. And for the whole year, we are also positive that there will be steady growth, and we are also expecting that the demand, at least our growth rate will be more than 12 to 15% in the range as far as the individual housing loan disbursements are concerned for the whole year, current year. Then the second question you were asking about the construction finance. In that, of course, we are also very cautiously, we are also present in the market. We are also giving loans. Not that we have, actually would like to reduce that one. Only thing is what happened, because here and there 1 or 2 slippages were there into the NPA. That's why there is a shrinkage in that what you call the entire portfolio. Otherwise, of the project finance, now it is constituting around 5%. But in the days to come, we are very sure that this definitely will increase, and we are also focusing on more smart cities where we can give the very good project loans, even to the range of 100 crores or so. So that what happened, there we can have very good, in the sense, presence and also expand our loan book in the project finance. This is one thing as far as the project finance matters are concerned. Then I think regarding cost of funds, you are inquiring. No, what is that regarding? Second question.
Yes, sir. If you look at the bank funding, sir, what proportion presently is on EBLR versus NCLR, and what sort of pass-through are we likely to see going forward, sir, in the next foreseeable 12 to 15 months?
Yeah, as far as the bank funding is concerned, about 32% of our total fund is drawn from banks, and most of them are linked either with an external benchmark or with a repo. So now, as you would know, that there has been today also there has been an increase in the repo. To that extent, a portion of that will get repriced higher. As far as the external benchmark is concerned, there is a little bit of remission in terms of the T-bill cutoff rates, because already it had run up quite sharply in the past couple of months. So I would say that there will be some impact, but obviously you would note that in the last month we had increased our PLR by about 60 basis points. Today, post RBI's decision also, we will take a decision at our ALCO in the next few days.
So, just a clarification on the construction finance, sir. Did you give a number on the growth? What sort of forecast or estimate we have for the disbursements for construction finance?
Construction finance, actually what happened now, we are very much focused on that also. This is also on radar, and then now we have strengthened our systems, and our people are also well equipped and trained, and we have kept a very good monitoring system, and all digital operations also in full swing. So we expect at least we will have to at least in out of total disbursements, the market actually our share in the project finance will be at least close to 78%. That's what we're looking at.
78% growth, is that correct, sir?
78% share in our now it is around 5%. Probably by end of the year, we'd like to have nearly to the level of at least 78%. That's what we're looking at. And moreover, nowadays we're focusing on the line of credit. That is also one good business opportunity we are looking into that.
Right, sir. I'll take this offline, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Kunal Shah from ICICI Securities. Please go ahead.
Yeah, hi. So the first question, again, just if you can give the exact numbers in terms of what has gone into stage 2 from the restructure. So overall, there was 2,400 crores increase in stage 2 and 1,000 crores in increase in stage 3. So how much of that is coming from restructure? You said 450 crores in stage 3, but how much would be in stage 2?
Yeah, you're talking about the transition from the March numbers, right?
Yeah, just this quarter. Yeah, just this quarter.
Yeah, total about 2,000 crores have moved.
To stage 2?
Yeah.
And 450 crores to stage 3?
Yeah, that is actually NPA. Yes.
Yeah. So that has come into stage 2. So
kindly note this movement, that this movement is not because of any movement in the DPD. Let me be very clear on the call regarding that.
Pre-COVID delinquency bucket is what you have considered.
It was reflected in S1. Now we have put them in S2. Again, to repeat, there is no movement in the DPD per se. It is exactly whatever it is, because obviously the clock has frozen when the OTR is in operation.
Sure. And stage 3 would be 450 odd crores, no?
Yeah, that is the stage 3 basically means that it is a
NPA only, correct?
Yeah.
Okay, got it. And secondly, when we look at it, this entire hike which has been there, okay, from 1st of July, which we did it on 22nd of June, we announced. So given the profile of the book, would it be fair to say that everything will get reset? Maybe if 96% are pure floating rate loans on our outstanding portfolio, then how should we see maybe in terms of the reset of this? Is it like 1 month, or it will be everything will get reflected in Q2?
No, everything gets reset as on 1st July 22. That particular date, all accounts, whatever is linked with the PLR, gets increased by 60 basis points from 1st July 22.
So fair to assume that yields which are there, which are reported as of now, or maybe 97 odd % into.
I'll tell you, here if you actually look at what is going to translate, obviously the loans which are in NPA, there will not be any benefit because in which way they are in NPA.
Yeah.
Apart from that, the loans which have been disbursed in the last 1 or 2 months, that also there is a minimum lock-in of 3 months. So those 2 months of disbursement will also not qualify for this hike. Apart from that, everything which is linked to the PLR, whether it is retail loans, whether it is non-housing corporate, whether it is non-housing individual, whether it is project loan, all will get moved up by 60 basis points.
Perfect. This is very useful. And lastly, so there would be no discounting which will be provided to this. I think there was some discounting, and this quarter yields have actually come off on a sequential basis. So would we offer that as well with the increase in the rates or no?
No, let us very clearly mention there is no discounting. There was a special exercise which was conducted in the month of April to retain some customers which are basically retail customers on the bulk side. Retail customers working with some corporates, etc., where we wanted to retain those customers because obviously of the good credit scores. So, and that has also yielded very good results considering the fact that as of March, the year-on-year portfolio growth was roughly around 8%. It has increased to about 10% in the June end quarter. So there was a specific, you can say, exercise being conducted to retain the portfolio to increase the growth. And that also was in the backdrop that we are looking at an interest rate hike almost imminently.
Yeah. No, so the only thing was maybe that 30 bps sequential decline, that is quite huge. So maybe that came all of a sudden because of this discounting on a larger part. On I would say that proportion was also quite high, which is resulting on 30 bps decline. So just wanted to be sure that there will be no such exercise going forward, which will create pressure on yields. Yeah. Okay. Yeah. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Krishnendu Saha from Quantum AMC. Please go ahead.
Hi, thanks for taking my question. And just a couple of understanding of the same, most of the questions have been answered. Just a couple of things. Your cost to income ratio is it's low for the last 3-4 quarters. You could throw some light at 12.8%. So what is the thought out there? And again, coming back to the yield and the post discounting 8.1%, do we the increase in the home loan yield and assets that will be on top of 8.1%, or you up for the discount not being there, so it should be higher? And you could just talk about the incremental cost of funds that's also gone up. So how do we see that net in the effect, looking at the NIMs and the spreads for the next 2-3 quarters? We just talk about that.
12%.
The first question was, Krishnendu, was on
on the cost to income. So just it's been low, 12.8%, I suppose, according to my calculation.
Yes,
what is
correct.
happening over there?
The cost to income ratio, if you look at in the entire housing finance space, I think LIC Housing has got one of the lowest cost to income ratio. And historically so. Cost to income you compare it with cost to assets, whatever. It is, and last year there was an elevation because there was a one-off payment regarding wage arrears. Now that it is not there this quarter, it has actually come to normalized level. Further, if you look at the actual the expenses on account of employee cost, etc., that has actually remained very stable with a slight decline sequentially. As compared to March, there has been a slight decline only. There has been no increase. So that way, if you look at it, I think cost to income ratio, it will be very stable, and it is reflecting the kind of cost discipline that the company has always maintained. And going forward also, by and large, this ratio will be maintained.
I see. Okay, thank you. And sir, Shripata, on the what do you call, on the NIMs and the spread. So our incremental cost of fund has gone up by, say, 30 bips. So how do we see that the new cost of funds for the coming quarters? And with 8.1 to 30, that's also a change in yield. So the increase in which you have repriced the assets. So is it on top of 8.4 or 8.1 for the quarter? So I just want to get that clarity.
See, of course, first question that regarding the margins last year when we had the annual call, I was very emphatic that we will maintain margin stability. Very clearly we had indicated, irrespective of the fact that we were looking at an increasing rate scenario, the management had very clearly indicated that margin stability will certainly be there, and that has been delivered by and large. There has been an increase in interest costs, as you know, across the board. 2 repo hikes till the first quarter, 1 more today morning. But despite that, we can share with you that in terms of margins, it will be stable. Last year, full year margin, one has to compare. There is volatility intra-quarter, but on a full year basis, there will be margin stability to improvement. Regarding cost of fund, yes, cost of fund has increased overall. The 140 basis points, including today's repo rate hike that the Reserve Bank has increased. But despite that, if you look at the 90 basis points rate hike which happened in first quarter, has translated to about 20-25 basis points increase in cost.
Okay. So net more for the NIMs, you expect at this levels to be maintained or maybe a little bit slightly better for the coming quarters because we'll be reducing the assets.
Full year basis, you will certainly see improvement.
Certainly, yes. Marginal, at least something.
Yes.
And if you can just, could you give us the breakup of the GNP for 4.96? What was the breakup, which individual LAP, LRD, where it came from? That will help from a data.
Thanks. We'll just share it. Just 1 second, I'll share it with you.
As far as the individual housing loan is concerned, it comes to 1.9%.
Mm-hmm.
And then non-housing, commercial, non-housing, if you put together, it comes to around 7%. Okay. Then project, the construction finance is 35%.
35%. Okay, that was increased. Okay. Thank you. Thank you for your time, sir.
Thank you.
Thank you. I request participants to please limit your question to 1 at a time now, since there are several others waiting in the queue. The next question is from the line of Rikin Shah from Credit Suisse. Please go ahead.
Sir, just had a question relating to the effective tax rate. It has been low for us in the last few quarters. Any specific reason for that, and how does it trend from here?
Effective tax rate on the full tax rate is 25.168. But you are aware that under Section 36(1)(viii) we receive a benefit on the amount of transfers that we make to special reserve. About 20% of our long-term income from long-term lending activities, that benefit we get under Section 36(1)(viii). So effective tax rate is around 18 to 19%. Around 18% you can say, 18 to 18.5% effectively.
And this 18 to 19% should sustain going ahead as well.
Yeah, obviously, because there is as of now there is no indication in the change in tax rates by the government.
Correct.
Okay, got it. I have a couple of clarificatory questions, and maybe I can come back in the queue.
Yeah, please.
Okay, thank you.
Thank you. The next question is from the line of Hitesh Gulati from Haitong. Please go ahead.
So thank you for taking my question. So my question is on the breakup between the restructured books, 3,000 odd crore restructured books that you mentioned. What is the breakup between wholesale and retail?
The retail piece is about 2,000 crores. The wholesale piece is about 1,000.
Okay. And then how much of upgrade recovery have we seen in stage 3?
No, sorry, I didn't.
So what is the recovery that we have seen in stage 3, sir? Have we seen any recoveries in stage 3 assets?
Stage 3 OTR, you are checking about OTR recovery out of stage 3.
No, yes, a normal recovery also, like in stage 3.
Yeah, normal recovery. There has been some recovery on the stage 3 accounts, both on the OTR as well as on the non-OTR, out of about 4,000 crores total.
So 4,000 is OTR recovery, sir. I'm just asking about stage 3 recovery, sir.
No. Sorry, can you be a bit more clear?
So in the stage 3 assets as of last quarter, sir, have there been any recoveries there, sir?
Stage 3 assets, yes, there has been recovery. Certainly there has been some recovery. See, actually it is offset by, I'll just share with you some numbers. Say for example, on the project side, we have a slippage of about 500 odd crores, but there has been recovery of 140 crores. So net on the net there is an increase of about 395 crores on the project side.
Correct.
Similarly, there will be a similar kind of an experience on the retail side also.
Okay. Thank you, sir. That's it.
Recovery is 500 crores of slippage, around 200 crores of recovery on the retail side.
Okay. Yeah. Thank you, sir. That's it too much.
Yeah.
Thank you. Request participants to limit your question to one at a time. The next question is from the line of Mr. Chavate from Kotak Securities. Please go ahead.
Hi. This is again just trying to understand the coverage on stage 2 loans. Your total ECL on stage 2 loans has gone up by around 590 odd crores. And what you mentioned is that the ECL transfer on account of the OTR transfer is around 400 odd crores. So the balance would be on account of what?
No, it is not 400. I thought that the number I shared was around 2,000.
No, that's the principal amount, right? So you moved 2,000 crores of loans from stage 1 to stage 2 for whatever the OTR transfer. Along with it, you moved around 400 crores of provision.
Provision is 400 crores.
Yeah. Now the thing is, if I look at quarter-on-quarter increase in stage 2 provisions, as you have reported, this is up by around 590 crores.
Correct.
So I was trying to understand what could be the difference for the balance.
The balance is a genuine increase in the coverage.
Okay. Because for a 300 crore of balance increase in stage 2, you have almost a 200 crore of balance increase in ECL. So.
Correct. There are two parts to it. One is that what I mentioned is that because of the movement or I would say a migration from the stage 1 to stage 2 to the pre-OTR DPD. So there, for that there is an attendant movement of the provision from stage 1, which was earlier residing in stage 1 to stage 2. Apart from that, on the stage 2 itself, the coverage has increased.
That's good.
Which is fair. So X of OTR, whatever is the stage 2 coverage, that we can
that has also increased.
Assume to be a more steady state coverage.
Yes, correct.
Sure.
There are two parts to it.
That's it. That's it. Perfect. Thank you very much.
Thank you.
Thank you. The next question is from the line of Param Subramanian from Macquarie. Please go ahead.
Yeah, hi. Thank you for the opportunity. I wanted to ask on the OTR pool, the remaining 3,000 crores, when will it move out of OTR? That's my first question.
Yeah, it will come out almost every quarter now. It has started moving out from the last 2 quarters. This was the 3rd quarter it was moving out, and it will probably go on for another 3 more quarters. That is, you can expect the bulk of it happening in September and December, and a bit of it in March.
Got it. That's clear.
Portion will happen in March.
Okay.
Very small portion happening in March.
Got it. And I wanted to understand of the book that has moved out from OTR, that 4,500 crores, what is the sort of collection efficiency or some sort of color you can give on how it is performing, that 4,500 crore book? You said 450 crores at slipped. But apart from that, how is that portfolio performing?
So regular means that the collection efficiency will be close to 100 only.
99%, more than 99%.
Yes.
On interest and principal overall, right?
Yes.
Okay. And my last question is, what is the interest accrued on the OTR pool currently, the outstanding OTR pool?
Outstanding OTR means...
the 3,000 crore, whatever, the 7,800 crore, if there is any interest accrued and not paid, what is that?
If you look at it, what I have mentioned, out of the 3,000 crores, about 1,000 crores the interest is being serviced. So there is no accrual, there is actual receipt.
Okay. And even on the overall 7,800 crore, there is no interest accrued and not paid. That's not a significant number.
The 7,800 number doesn't exist today. Now the number is not 7,800. It is actually, I don't know whether you were there in the beginning of the call, but the number is now not 7,800. It has come
Okay,
down.
Sir, just wanted to understand the amount that has moved out, they have repaid the accrued interest as well, or that will still be accrued, right?
No. See, there are two. Let me again clarify. people who have actually come out of the OTR, it means that for them it is, the repayment is as regular and as per the earlier.
So they have come to stage 1 full, as simple as it is.
Okay. Got it. Thank you and all the best. Thank you.
Thank you. The next question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yes. Morning. Good afternoon. Thank you for taking my questions. The first one is, while you have already shared, the stage 3 number was 7% on the non-housing. If you could just split it into commercial, non-housing commercial and non-housing individual, and then maybe I can take the next.
I'll give you the numbers. You can just do the about 200 crores in the non-housing commercial and about 187 crores. 1879 crores in the non-housing individual.
Okay, so non-housing individuals you said 1879 crores and non-housing commercial you said 200 crores.
Correct.
Alright, sir, this is useful. So now kind of coming to my question, I wanted to understand, how are our contracts structured? Basically, what is the repricing frequency? Kind of trying to understand that you suggested that you took a PLR hike of 60 basis points in June, which becomes effective from 1st July. And now that there is another repo rate hike of 50 basis points, you suggested your ALCO committee might again meet and kind of decide on the next course of action. So just wanted to understand at what frequency does the repricing of the back book happen?
See, there are two ways, two different. Of course, you have asked only specific to the back book, but as far as the new business is concerned, that can happen anytime. So, for example, just to give an example, if it is decided to increase rates today, it can increase today. If it is decided to increase from tomorrow, it can increase from tomorrow, like that. Now, as far as the back book is concerned, at the time of signing the loan offer letter, there are 4 dates on which it will be moved. That is 1st July, 1st October, and like that. 1st January, 1st April. That is subsequent to the completion of the quarter. So those are the pre-contracted dates. That is for the old loans. New loans, we are free to decide depending upon whatever contractual obligation or contractual arrangement we enter with the new customers.
So if I understood this right, so newer customers, incremental lending, like you said, whenever the new PLR kicks in, it's effective. On the back book, after the completion of the quarter, the first of the month, as in basically the next one could potentially be 1st October then. So there could be a lag in the transmission is what we are suggesting. So costs go up, but the back book can get repriced now only on the 1st of October.
I will put it this way, it works both ways. Today we are looking at a scenario where the rates are increasing and probably in the next few quarters the same query will be when the rate will start coming down. So it is, I think, in a declining interest scenario, it works in, the mechanics give a different result.
So fair. Point taken. And just squeezing one last question. So while we have a provision cover of about 40% on our gross stage 3, if you just kind of give the split of this provision cover based on project loans, non-housing, commercial, individual and individual repayments. What is the provision cover that we are carrying on these 3?
Yeah, individual housing loan, if you look at the PCR, it is 44%. And non-housing commercial, it comes to 37%. And the non-housing individual also, it is almost all 38%.
And on project loan, sir?
Project loan, it is 38%.
38%. Thank you so much, sir, and wish you the very best. Thank you.
Thank you. Request participants to please limit your question to one at a time. The next question is from the line of Pankaj Agarwal from Ambit Capital. Please go ahead.
Yeah, hello, sir. Sir, this 30 billion of restructuring is part of stage 2?
Sorry?
This 30 billion outstanding restructuring where there is a principal and interest moratorium, is it already part of stage 2?
No. See, it is not 30 billion. Principal and interest moratorium is 20 billion, not 30.
Yeah, 20 plus 1,000 separately, right? So total 30 billion.
1,000 is principal only, and 20 billion is principal plus interest. It is parked in both 1 and 2 depending upon the DPD at the time of invoking the OTR.
Okay. But would it be fair to say that a majority of this 30 billion will be in stage 2? I mean,
stage 2, yes. Yes. Correct.
Okay. And second thing, so that's leaving aside the provisioning coverage, given the quality of collateral you have, right? And given your stage 3 assets and restructured loans, what could be the ultimate LGD on all these loans? Based on quality of collateral, LTV, everything, and based on past experience.
So you are talking about the book in entirety or separate buckets?
Especially like your restructured plus stage 3. I mean, though I know regulatory requirement is different, but ultimately
I can share with you the loss rates of the company or the write-off rates, which is actually the LGD. The ultimate LGD is basically the write-offs which have happened cumulatively in the company since inception is 411 crores, less than 500 crores over 33 years. And out of that, we have collected about 140 crores. 240 crores we have recovered out of those 400 or 500 crores. So actually, if you look at the actual loss rate, I would say it is in single-digit basis points, considering the fact that over the last 33 years, we have disbursed almost 5 lakh crores of assets.
And you believe that future won't be materially different from the past when it comes
adequate the provisioning coverage that you have seen on the stage 3, or you leave aside stage 3, you look at on a total coverage ratio basis, TCR basis. TCR basis is also around 2.5% now. Whereas if you actually look at the loss rate, that is in single digit basis points.
Okay. Fair enough. Thank you very much. Thank you.
Thank you. The next question is from the line of Prashant Kumar from Sunidhi Securities. Please go ahead.
Thanks for the opportunity, sir. My question is on credit growth side. Although the disbursement dipped sequentially, but the total advances inched up a bit. It must be due to lower prepayment. So is it fair to assume the stiff competition from banks due to lower pricing are easing in rising yield scenario? And if you could give some color on growth side of individual housing loan as well as the whole book for FY23.
Yeah, as far as the disbursements now, what you are inquiring is now, actually the current quarter, the Q1 was very good. And going ahead, Q2 also, of course, this is a very big in the actual market there. There will be certainly competition from all where banks will be there, HFCs are there, all are there. And one good thing is our strength lies with our MIs and our reach across. Especially the MIs, nearly our market intermediaries, more than 10,000 people. They are providing good support in our reach as well as even our what we call volumes. So with that, I think we will have fair enough, our share will be there in the market. Then recently we have also what you call equipped the other line of officers, we called it the processing centers at some important centers. So what happened now, the TATs are maintained very well. And even digital operations, what we now engaged into, they are also giving good results. So going forward, I think we will have very good edge in the market as far as the new disbursements are concerned. And growth for the current year, we are almost aiming at 12 to 15% in our disbursements. That's one thing. Then as for even our existing book, the total portfolio also, will be more or less moving in the same range of 12 to 15% by end of the year.
Okay. Thank you so much.
Thank you. The next question is from the line of Arjun Bagga from Baroda BNP Paribas Mutual Fund. Please go ahead.
Yeah. Hi, sir. Thanks for the opportunity. So just regarding the yields, so the decline that we had QOQ during the quarter, can we attribute that entirely to this repricing that we did?
Yes.
And
also some high ticket, some high yielding loans getting prepaid.
Okay, sir. And as you disclose that this 60 basis points increase in the PLR, that would be applied to, I think, all the loans going forward, and that is going to help our yields going forward. Is that understanding correct, sir?
Yes. Yes, correct. This quarter onward it will be there. Definitely will be there.
This quarter onwards, like entirely. Sure, sir.
Sure.
That's all from my side. Thank you.
Thank you. The next question is from the line of Vipul Kumar Anupchand Shah from Sumangal Investments. Please go ahead.
Sir, I have a small suggestion. If you put all this individual project, non-individual, all this provision and all these figures in your presentation, it will be really helpful. And if you put the name and phone number of the person in your investor relation team to be contacted in case of any further queries, it will really be helpful.
Yeah, we'll consider that. Thank you.
Thank you.
Thank you. The next question is from the line of Sanket Chheda from BNK Securities. Please go ahead.
Yeah, so just a follow-up question on what Mark asked, that maybe last quarter that the restructured number has been lower than 30. So can you give me what that number last quarter? OTR number?
No, your voice is breaking. It is not at all clear.
OTR number, which quarter you wanted? March.
March quarter, yes, sir.
The total OTR given till March is 7,800 crores.
That is almost 3% of the book size.
Yes.
Okay, so in previous discussion you just alluded that number would have been lower. And the 148 crores that we have provided on the back of RBI notification of reclassifying and which sits in stage 2, stage 1, what would be that quantum in absolute terms against which you have created 148 crores of provisions?
Can you come again, please?
So as per RBI notification of November, you have mentioned at bottom that you have provided 148 crores or create 148 crores of provisions.
Yes.
I'm saying what would be the absolute quantum against which you have created this provision?
Okay. See, it is about 1,400 crores.
Okay, sir. Sure.
10%.
Thank you. The next question is from the line of Rikin Shah from Credit Suisse. Please go ahead.
So the first one is on funding cost. Last quarter, your incremental funding cost was 5.1%. This quarter, it is 5.4%. And despite of that, the overall funding cost has moved up from 6.5 to 6.7. So any color on why the overall book has moved up, even if your incremental funding cost is still at least 130 bit lower than your overall book? That's the first one. And second, just wanted to clarify, out of 3,000 crore of remaining outstanding restructure, 2,000 crore will be in the stage 2 and 1,000 crore will be in the stage 1. And the last one is the non-housing commercial NPA. Was it 200 crores or 2,000 crores? That's it.
Your first question regarding the cost of funds. The incremental cost of fund has increased, but there is also repricing on the back book. Just like there is repricing on the back book on the asset side, there is also repricing on the back book on the liability side because of the linkage with the external benchmarks or the repo. Right.
But if your incremental repricing is happening at 5.4%, that is your incremental cost of funds, then why would the overall book move up?
So because the back book, 30% of the bank, you have to see the amount of the back book and the amount of incremental borrowing. Incremental borrowings in the first quarter will be around 10,000 crore. The 30% of the back book is around, say, 60,000 crores. So obviously a 5 basis point increase in the 60,000 crores and a 5 basis points increase in the 10,000 crores will have a different kind of an impact.
Got it.
These are comparable.
Fair enough. And the remaining two questions, sir?
Remaining two questions, can you please refresh?
The restructured 3,000 crore split, 2,000 in stage 2 and 1,000 crore in stage 1. Is that correct?
Yes.
Correct.
Okay. And last one, the non-housing commercial NPA, is it 200 crore or 2,000 crore?
Sorry, 2,000 crores. My bad. It is 2,000. Sorry. 2,000 plus non-housing individual 1,879 crores. Total around 3,888 crores. And the total outstanding is 33,500 crores. So it is around 10%. If you add the two.
Got it.
Sorry, but it was my slip. Thank you for correcting me.
Earlier also we told you, coverage ratio also.
Around 10%.
Yeah, correct.
Yeah.
Thank you very much, sir. This is helpful.
Thank you. The next question from the line of Gaurav Jani from Prabhudas Lilladher. Please go ahead.
Thank you so much, sir, for taking my question. Two questions. One is, you mentioned that about 60 basis point is the yield hike that we have taken. Proportionately, by what amount or by what percentage would the cost go up?
On an estimated basis,
yes.
See, the cost of funds which has increased in Q1 on the book is 18 basis points. Obviously, there will be further increases because of further repo hikes, etc. Today we had a repo hike of around 50 basis points, and we'll see what is the translation or transmission of that to the various markets in terms of whether wholesale market and then the bank loans, etc. But it is expected that after this rate hike, there will be some indication of stability. That is number one. If you look at the 10-year bond yields, there is already a reduction from the 750 levels to about 720, 730 levels. So that is one thing. There will be increase in the cost of funds, but that will be more than made up by the increase in PLR that will be affected by us, including the one that has happened, that is effective 1st July.
So you would mean, sir, that the 50 basis, so the increase in cost of funds would be lower than 60 basis points on the yields.
I will give you just one data point that will help drive the point home. Almost 60% of our liability book is on the fixed rate side, and 90% plus of the assets are on the floating side. I think your question is answered.
That will take care.
Got it. Thanks. So this last question from my end. We are at a stage 3 at about 5%. Taking forward one of the previous questions on recoveries. So do you see that recoveries would exceed slippages in the coming year so that our overall GNPAs would come off, or how should we look at it?
Sure. I think what happened now, the recovery teams are well in place, and moreover the efforts also on a full swing. So on all fronts, maybe OTR or maybe even in our the other what you call defaults, even a regular case also excellent follow-up is being made now. So that what happened, the overall collection efficiency will improve in all the segments, maybe regular or even defaults and all. And even what happened even in the non-housing sector also, like non-housing commercial loans also, the teams are put in place to what you call to make them regularize as well as further in this quarter. So mostly there will be an improvement. That's what we are very positive.
So because where I was coming from is, sir, in the coming quarter, you'll also see, the OTR pool coming up for payments, right? So, yes. Of that, or after that, could we see, net slippages being negative or rather higher recoveries? That is what I was trying to get at.
Correct. OTR case also what happened, our teams are even in association with the grassroots level people are working for the past even 2-3 months already. So what happened, majority of them will be brought out of this OTR and adequate information is being shared. If they come out, what is the benefit and also. Teams are working for that, for a better improvement in the OTR also. With that, we are very sure that I think probably slippage will be less and then the recovery will be better.
Got it. Thanks. That is it. All the best.
Thank you. Ladies and gentlemen, due to time constraints, that was the last question for today. I now hand the conference over to the management for closing comments.
Thank you for arranging this and also all the queries you have put in very nicely. and we are now in an improving economic cycle with the impact of COVID almost reduced very, very significantly. Despite increase in interest rates, the housing demand continues to be very, very healthy and robust, and we are highly confident of improved performance on the back of a very good first quarter. Thank you and wish you all the best. Azadi Ka Amrit Mahotsav. Wish you all the best.
Thank you. On behalf of Axis Capital, that concludes this conference. Thank you for joining us, and you may now